Hello everyone, my name is Cameron Stevens and I'm a local real estate agent here in Los Angeles. Today I'm going to be talking about closing costs. All of the things that you have to pay to purchase a property. We'll talk about what you will pay as the buyer, what the seller will pay, and many other aspects of closing that can be negotiable. One quick disclaimer on closing costs is that customs for closing costs vary state by state and even in areas of the state as well. For example, within Northern California, buyers usually pay the title insurance premium, while sellers usually pay the premium in Southern California. Again, this is all customary, but everything is negotiable. That being said, every single offer that I write and every other offer that I see written for homes that I'm selling tends to be pretty consistent. So we're going to stick to the customary closing costs just for this discussion. I'm going to do this video from the perspective of the buyer first, and then go over a few items that are unique to sellers. Okay, let's start with the very first one. Not a closing cost per se, but it does roll into the final settlement, so I'm going to include it here, and that's the earnest money deposit. I could do a whole video on the earnest money deposit, and maybe I should, but here's a little quick and dirty. It's 3% of the purchase price. It is wired to escrow within 3 business days of an accepted offer. It is fully refundable if you properly exercise any of your contingencies, but not refundable if you would like to pull out of the purchase after you've removed all your contingencies. It does become part of your down payment, so if you're putting 20% down and 3% is in escrow from your earnest money deposit at the very beginning, then your remainder of the down payment will be 17% of the purchase price. Okay, now for the list of what most people consider to be closing costs, which are things above and beyond your down payment. First is property tax. Now, property taxes in California are due twice a year, November 1st and February 1st. They are prepaid for the period, so it is highly likely that one of 2 scenarios will play out. Either the seller has prepaid the property tax and then they're selling the property to you, thus it will be a credit to the seller for the property tax for the difference in that time period. Or the seller will not yet have paid the property tax up to the sale date of the property, and it will be a credit to the buyer from the seller for that difference. Now, speaking of credits, they will also show up on your closing costs. Now, most often we see credits from the seller to the buyer for issues that came up during the inspection process. Because this is cash that the buyer would need to pay at the close of the property, we typically refer to any credits to the buyer as cash in hand, i.e. cash that you have to spend immediately. Now, the next category is title costs, and the big one is title insurance. In Southern California, the seller typically pays the title insurance as a way of stating that they are handing over the property free and clear of any title issues. However, the buyer does pay their portion of the title insurance called the lender's insurance, which is separate from the seller's title insurance and specifically covers the lender. Now, usually this is cheaper than the seller's title insurance because it does only cover that portion of the property that the lender has lent on. Then you have all the little title fees, which include recording fees and deeds of trust and recording the grant deed and wire transfer fees and notary fees. Now, most of these you can't really shop around for. They're kind of just built into the title company. So you do want to make sure that you choose one that is reputable. However, it is worth noting that title fees are heavily regulated, so you can pretty well know for sure that you're not just randomly paying double what another title company would charge you. Next are your escrow costs. Now, as a reminder, escrow is paid to be a neutral third party that gathers all of the documents and money related to the transaction and then disperses them properly. Now, they too have to be paid for their job, and they have a settlement fee, usually a document preparation fee, and possibly some small loan tie-in fees as well. Now, it is worth noting that both the main title insurance and escrow fees are typically tied to the purchase price of a property. It's like a point system, basically. It's a flat fee plus a percentage of the purchase price. Finally, you have lender charges. Now, most of the time you are not closing exactly on the 1st of the month when your mortgage payment becomes due, so You'll prepay the interest on your loan up till that very first mortgage payment on the next first of the month. There are also underwriting fees, which is the cost of the lender to evaluate and create your loan. Then there are small fees such as a credit report, flood certification, and tax service fees. Now, any lender credits that you may have by either paying points or taking a higher interest rate, they will also show up in this section as well. Finally, you have a few miscellaneous things that are handled at closing. You will pay for your insurance for the entire year. The home warranty also shows up here. However, it is customary for the seller to pay for almost all, if not all, of the home warranty. HOA dues, if applicable, they will show up here as well, but obviously that's only properties that do have a homeowners association like condos and townhomes. Okay, that generally covers the closing costs from the buyer's perspective. Let's talk about a few things that are unique to the seller. First, you have the broker commission. Now, many people don't understand exactly how commission works in real estate, so here's a quick breakdown. The seller pays the commission for the sale of the home to the listing agent. The listing agent signs an agreement that they will share a portion, usually 50%, of that commission to the buyer's agent. The seller has this taken out of their proceeds on the sale of the property, and each portion of the commission, the listing agent and the buyer's agent, are paid out of escrow. Next is the documentary transfer tax. Now, this is a government tax on the transfer of real property over and above any lien, and it's also called the real estate transfer tax in other states. This is California after all. We definitely have our state taxes. Finally, the seller has to pay their portion of escrow fees. It is customary in Southern California for each party, the seller and the buyer, to pay their own escrow fees, which roughly works out to about a 50-50 split. Now, this isn't the way it is in all areas of California, but that is usually what happens in Southern California. So this covers all of the common closing costs you'll see when purchasing a home. Remember, as a buyer, you will have to pay these in cash at the time of the purchase of the property. See, the seller can simply have their closing costs taken out of the proceeds of the sale, but the buyer will need to have these funds liquid before closing day. I always tell people to estimate at least 1.5% of the purchase price, 2% to be safe. That's a pretty important number, so I'll just reiterate that. A minimum of 1.5% liquid in cash for closing costs. Now, luckily, this is something a good lender will work with you on before you even go down the road of a pre-approval, so you really shouldn't have to worry. Now, one quick tip I have for buyers before I wrap up this video. You should know that your monthly payment is estimated with PITI, principal, interest, tax, and insurance. But wait, as I talked about above, insurance is paid for the year, and taxes are due twice a year as lump sums. That's because your actual mortgage payment itself only includes principal and interest. But there are other things that are obviously payable, so you want to budget for them accordingly. All lenders will offer the ability to create what is called an impound account or an escrow account, not to be confused with the escrow for the purchase itself. And this will be used to collect an estimation for your property taxes. This is either to protect new homeowners that were previously renters and used to paying that flat monthly housing payment, preventing them from not budging properly, or, people that simply want the convenience. However, my tip is actually not to do this. That's right, I usually recommend my buyers not to set up an impound account. Why is that? First, this is money that you are pre-loaning to the government. At closing, they could impound multiple months worth of property taxes, which could actually be a lot of cash on hand that you'd have to fork over. Additionally, I've heard horror stories about lenders taking far too much or not enough, leaving buyers to foot the bill or taking a refund far after the fact. For anyone that has the variability in their income, like a lot of folks here in the film industry in Los Angeles, it is far easier to wait and pay your property taxes if you're in any kind of an income gap. As I mentioned before, property taxes become due twice a year. That's November 1st and February 1st. However, they don't become delinquent until December 10th and April 10th, respectively. I always suggest being diligent and put aside your property taxes and obviously pay them before the delinquent date. So that wraps up our video on closing costs. I hope you found this video informative, and if you learned something, please don't hesitate to share it with someone that might be interested in purchasing their first home or even selling their current home. This market has low interest rates for buyers, but has also been commanding top dollar for sellers because of a lack of inventory. And I have been highly successful on both sides of the transaction, so if there's anything that I can do to help, please reach out. Thank you so much for watching.